All right, well, let's get rolling here and then we'll get everybody on their way today. So I'm going to talk about a few different things today. Obviously, there's been some price action that has a little bit of concern on it, and I want to talk about that. But before I jump into where prices are and what we're seeing moving forward, I do quickly want to just do some quick kind of more reminders than anything. I think most people have probably already signed up for ARC County and PLC. The sign up deadline at the USDA FSA service offices is March 15th. And just a couple of generalizations. Given where market prices are right now, there's a low likelihood of payments under either one of those programs if we get anywhere close to normal yields. The big thing is I still encourage people to sign up because the choice, since it's a free program to participate in, is zero or something that's greater than zero. So again, there's no downside risk in signing up for these programs. So if you do have producers with base acres, make sure that they're enrolling them in ARC County and PLC before the March 15th deadline. When we look at corn, soybean, and wheat base acres, again, it's not paid on what's planted, it's paid on what the farm's base acreage is. In general, ARC County is going to be the better choice just because of where our prices are relative to the reference prices for PLC. Unless you're looking at that SCO crop insurance being purchased, it's a requirement to be in PLC if you're doing that. We don't have high adoption of SCO, so that usually doesn't come into play. So for those three bases, it's typically going to be ARC County. Seed cotton is a little bit more unclear. It's a little bit closer of a decision. I think you can make an argument based on market conditions that we might want to consider PLC with the SCO option over ARC County. But what you really need to end up looking at, and if people have any questions on that side out in West Tennessee in particular, you really have to look at what those county level yield guarantees are for the ARC County program to make that decision. But these are just a couple of generalizations. If people haven't done it yet, I encourage them to do so because again, it's a no risk endeavor. I want to start out with yesterday we finalized our crop insurance or our projected crop insurance prices for corn and soybeans for the 2023 crop year. And so I did want to just highlight where we're at, just a couple of quick points on it. When we look at crop insurance, it's one of our primary risk management tools for our row crop producers. And when we look at corn and soybeans, there's a couple of differences I do want to point out. But corn, the price is set at $5.93, so we're elevated a little bit from where we were last year at $5.90. The other one that I do want to point out is that volatility factor during the price determination period is actually down. It really doesn't mean much in terms of the price, but it should help save a premium if you're looking at the same coverage relative to last year. So that's a little bit of good news on the premium side of things. When we're talking about crop insurance, again, because we still are in a high input price environment, I do think it's important to stay on top of that buy-up coverage level. So when we're looking at selecting, most producers are going to be somewhere between that 70 and 85%. You know, I would sit down with the crop insurance agent, make sure that we run those numbers and we get the most out of the protection that we have in our crop insurance. The other one that I will say is I'm always a bigger fan of maintaining that second roll of the dice in terms of the harvest price period. What it does, it allows us to end up increasing our revenue guarantee if we do end up seeing higher prices in the fall. So again, those are kind of just some generalizations for this time of year as we're looking at finalizing the crop insurance products that we have. I did mention that the soybeans are a little bit different. We're actually down not quite 60 cents off of where we were last year in terms of our revenue guarantee. Again, we should see cheaper premiums in soybeans if we have the same or similar coverage to last year because of this price volatility factor. And so when we look at what's going on right now, again, I think it's really important to look at the unit structure and the buy-up coverage levels that are on our farms to make sure that we're getting the most out of our crop insurance coverage for this growing season. The other thing that I do want to just quickly touch on, because the USDA hosted their Outlook Forum last Thursday and Friday, and they released some updated or some preliminary estimates for the 2023 crop. And there's a couple of things in here that I just want to end up pointing out. And it just kind of points to direction. This time of year, I don't put a huge amount of stock in projections just because there's so much uncertainty for the 2023 crop year. But when we look at where we're at, this return to kind of a trend line yield, the corn one kind of surprised me a little bit. 181.5 seems a little aggressive based on what we've seen in recent years. But again, we don't know where that's going to end up being. The key that I think I want to point out is this ending stocks number, and this bodes for a little bit softer prices as we look into 2023 if these numbers are realized. And again, with the full exception that we have a tremendous amount of uncertainty in what we're looking at for new crop this year, but relative to our old crop, the new crop, there's definitely a little bit more kind of a softness in prices where we're starting at right now. So again, that's just something to consider as we start looking at how we're going to manage our price risk this season. Another big one I think is going to be really important for the 2023 crop is how our exports end up performing relative to where we were in 2022. And so we talk about this old crop, new crop, and I'll get into the price spread and some of the action that we've seen recently in corn and soybeans. But there's some pretty big difference that I do want to point out between the 2022 crop and the upcoming crop. And most of it revolves around these stock numbers. And so when we look at ending stocks for the 2022-2023 marketing year, that's the one that we're currently in versus where they're projecting in 2023-24, you notice a much tighter stocks ratio there, right? And I think that's reflected in our price spreads. The question on my mind is where are we going to end up going between now and say July in terms of old crop prices relative to new crop? Because if we think about it, the longer term that we look at it, we'll talk about the divergence and then the potential convergence of prices as we move through the season. But these are very different supply and demand dynamics that are at work right now. Now, again, these are subject to change, but we have much more information about the 2022 crop than the 2023 crop. So it's just an important factor when we look at it, and a way to kind of conceptualize the strength or the price response for corn is to look at that stocks to use ratio. And I think this kind of highlights where we're at in 2022, where we've got elevated prices. The projected price right now is right around that just under $7 range. And that's represented in this green bar. We still have a bunch of uncertainty there where they're projecting a stocks to use to price relationship for 2023 is this red box. And so again, there's definitely, if some of these numbers come to fruition, some softness in these prices where we're probably looking somewhere in that 450 to 550 price range on the national marking your average side of things. So again, this isn't cash prices, this is marking your average prices. We'll talk a little bit about futures and cash prices in a little bit here. When we talk about soybeans, the one key thing that I do want to point out on soybeans, and this is one of the reasons why we've seen a little bit softer prices for the crop insurance price determination period for the new crop, is this divergence in foreign stocks. We still have incredibly tight domestic stocks, which is really good for our prices. But one of the big concerns out there is Brazil's got a really big crop coming to market right now, and that's going to increase some of the global availability. Now, there's other things that are counteracting that. Argentina went through a really bad drought. So again, we'll have to see where these numbers come out. But again, you see that softening of the prices, both for corn and soybeans, where the national marketing year average price for this marketing year is $14.30, for next year $12.90. So again, it's just something to keep in the back of the mind of the supply and demand environment that's currently being projected and how that's going to evolve as we get more information through the production year. This is, again, a little bit different, and I think it bodes, again, to the strength of the stocks to use that we have domestically. Yes, we are having a slightly projected lower price based on our stocks number, but again, we're not seeing that wide divergence of corn. Now, the biggest factor that I see in that corn market that I'm a little skeptical of in terms of the production numbers at 181.5 bushels per acre. A lot of things are going to have to go right for us to achieve a national average yield that high. So again, big difference between what we have for the 2022 crop year and 2023 crop year in terms of stocks, and that's reflected in our price differences right now. When we look at just kind of a quick summary of supply and demand, there's still a lot going on with Russia's invasion of Ukraine. That's going to continue to influence our grain, energy, and fertilizer markets. That's not going to go away. What it does is add a degree of uncertainty and unpredictability to the markets. And so we're subject to potential wide swings, particularly on the grain side of things, based on what's going on there, and not just the production side of things, but access to markets, right? There's a lot of news or ag news that focuses on the ability to ship grain and other products out of that region. That's going to continue to be very important. Another one, and again, this is something that if you've seen me talk through this winter season, you know, there's still a lot of global and economic forces outside of agriculture that are really influencing markets. That's going to continue in 2023, particularly as it relates to inflation, interest rates, and economic activity. And so again, we have to be cognizant of how things change, not just in the ag markets, but in the general economy as well. Already touched on corn and soybean supply and demand. But again, I think the key there is that we do have tighter domestic stocks for the old crop. We a little bit more stocks and lower prices for the new crop. One of the big ones that I'm interested to see in projected planted acreage is, you know, that kind of battle between the cheaper inputs on the soybean side versus the better price ratio on the corn side of things. Now that's softened a little bit recently with some of the action that we've seen in the futures market. But again, I do think it is important to kind of look and see where we are in terms of profitability across crops. Now, I'm not saying people should switch in and out without consideration to the long-term effects of a solid rotation and making sure that you have a balance so not all your eggs in one basket. But we do have to end up taking a look and see what's the marketing offering, what's some reasonable projections in terms of profitability for the upcoming year. When we start looking at prices, again, I've showed this a fair amount, but where we're at right now in terms of the December corn futures contract for 2023, we've averaged 596. We've seen some weakness in the last about week and a little bit, where this it started pulling down a little bit. But I do want to point out the fact that we're not going to end up having volatility exiting these markets anytime soon. There's still a huge amount of uncertainty due to a whole bunch of different factors. And so again, when we look at where we're going to be potentially heading for 2023, I think it's going to be really important to see which way we're going to break. Right now, we've seen some softness, but again, there's still so much time left in this production year that I don't think this volatility is going to exit the market. I did mention kind of the price action we've seen the last couple of days has been a little bit concerning, particularly on the old crop. We've seen some softening where we lost about 50 cents. Now, again, I'm still a firm believer of a good price risk management and marketing plan. You know, if you had a good plan before the drop, I think it's still a good plan after. But again, it's going to take some work if we're going to try to recoup the 50 cents that we lost there. Again, I think one of the big messages I've had through this winter meeting is to end up taking that price risk in the futures market off the table and let basis do its work on the old crop. I think that's a winning strategy for most of our Tennessee producers, because our basis, I think, is still going to remain very strong and improve as we move through summer. Where we don't have any control is on that old crop. So again, I'm not saying we're not going to be able to recover all of this, but again, I think our bigger price improvements on the cash side for crop held in storage is going to occur on the basis side. Again, when we look at the new crop, which is the green and red bars, we have been in a downward trend since back in October. So again, we're going to have to see what this crop brings in terms of whether we're going to end up seeing an improvement or we're going to settle down closer in that mid-5 range, or maybe a little bit lower if we end up getting higher acreage and yield than what we thought. Same set of circumstances for the November soybean contract. Again, we've averaged 1382 right now. But again, we're not anticipating this volatility to exit the market. So again, we're going to continue to see some of these price swings that are going to provide some opportunities for pricing. The question is, where do you want to pick that point in the futures market where you want to end up taking some of that risk off the table? And if you do have producers that are interested in things like HTAs, short hedges, or option strategies, we can definitely step through, you know, some of the risks and rewards of entering into some of these things. So reach out to me, and I'd be happy to discuss, you know, some of these different marketing strategies that can end up working either for crop and storage or for the crop that we're going to be planting this spring. When we look at that price spreading, again, what we ended up seeing is this black line is the March contract, and the green and red line is the November soybean futures contract. What you see is that price spreading, but we see that correction here again. This price line has been a little bit stronger on the future side than what I would have initially expected, but a lot of that is because of how little we have in reserves in the U.S. I was chatting with a few guys out in Memphis at the Farm and Gin show, and there's a pretty good consensus that we'll actually probably end up importing soybeans from Brazil sometime this summer because of the lack of stocks. And it's not unusual for us to end up doing that. The question is just the amount that we would potentially end up doing that until we can get to this new crop. So again, we still do see strength in these old crop prices based on what we have in terms of stocks. So just to kind of close out kind of my portion of it, I do want to talk about some of the risk management and marketing strategies. Obviously, crop insurance is that key stepping stone right now. Getting that to work for you in terms of providing a base level of protection. Again, that higher buy-up I like because of the elevated input cost environment we are in. Again, we're lower than last year in general, and we have seen fertilizer prices come down pretty substantially. But we're still going to have some pretty big investments in this crop. So we want to make sure that we're using that crop insurance to end up covering off some of that financial risk. The second one is more kind of in-season price risk management. And there's a lot of different ways that we can end up going here. I know there's a lot of people that use cash forward contracts. They can work well. I'm not necessarily a huge proponent at this time of year just because you have a tremendous amount of production uncertainty. I think there's more effective tools such as options that you can end up utilizing to manage that in-season price risk. And the key to me is always identifying those price risk intervals and kind of using those options contracts to bridge that for a defined period of times, not carrying them all the way until the contract expiration, but just for very defined intervals to alleviate price, and then rely on cash forward contracts or HTAs or a short hedge to end up setting that price. And then the last one I want to talk about, I updated our storage numbers, or our returns to storage. And I just want to share kind of what we see in terms of seasonal price improvements, because we got the 2022 data in there. When we look at in-season pricing, one of the big questions I always get about new crop is, when should I end up looking at sales? And there's not a one size fits all answer for this. The thing that I do use as a starting point a lot of the time is where that projected price is relative to what the harvest futures contract is offering. And the way to end up reading this is these black lines here are the projected price, so the crop insurance price, and then these dotted lines here are the ones that are the November soybean futures contract. And so again, when we look at 2022, anytime you get above these crop insurance price guarantees, that might give you a strong indication that you want to participate in some type of price risk management. And so again, I think this just is a useful reference point to end up looking at, okay, where are we at in terms of our crop insurance guarantee versus what we're looking at in terms of market offerings? And we see that in the corn contract here, right? And you see that the two are pretty close to the same, 593 versus 590. We had that big break in December corn futures last summer because we got dry and there's a lot of concern about reduced production. Again, one thing that is important in addition to the price movement is you have to have an understanding of where your production is. Because obviously we're not going to pull the trigger on pricing a bunch of crop if we're concerned that we might have a production shortfall. And so again, you have to work the two in combination. But I think if you are looking at the distance between the insurance guarantee price versus what the market's offering, I think you have to give some consideration to where you are in terms of price risk management. When we look at breaking down price risk, I think this is a real key to marketing in Tennessee, is to understanding where our risk comes from. And this holds for both crop in storage and for crop that we're going to be planting. We have typically very strong basis in corn in the state. And so when we're looking at a cash price right now of about 670, and you have 570 embedded in the futures price, that's 85% of our price risk. And I think that's why it's important to consider taking this off the table through either an option strategy or through an HTA or some other type of price risk management tool, where we're alleviating some of this price risk and then allowing basis offerings to do their things. I think we're going to end up having a reasonably strong basis environment because of the shorter crop in West Tennessee. Our state yield was down a fair amount. And so I think a lot of our strength is going to come in basis. The futures price remains very unpredictable still. So again, I always look at, let's kind of use this to end up paying the bills and this to end up maybe have a little bit of extra play money or a little bit extra profit that we can build in there and roll the dice a little bit more, because this in general is going to be more predictable than the futures price. And so one of the things that I don't mind doing in terms of a new crop strategy right now is buying a 550 December put for 32 cents. It sets a 518 futures floor. And a lot of people are going to say, well, I don't want to spend that 32 cents. The key to this strategy, you're hoping that you don't actually end up getting in the money. What you want to end up doing here is, if you buy this this put option, what it does is it adds a level of price protection. And once we get into that growing season, it's kind of that June, July, where we typically have a better understanding where that crop is, there's a high likelihood that you'll be able to recoup more than 50% of this premium by exiting the position and then moving into a cash forward contract position or another position. And it's all about how you remove that price risk from what our selling price is going to be. The big thing that I like about this strategy is it leaves that upside open in the futures market. So if it gets dry in Illinois and Iowa, or there's a production disruption down in Brazil, and futures prices shoot back up to $7, hey, we're willing to eat part of this premium if we're going to end up getting $7 futures prices, right? The second one that I really like about this is it allows us to set our basis at a later date, which I think is always very important. Depending on what part of the state you're in, you're going to have different expectations in terms of what your basis offering is. I've threw in $1 here. I think for a lot of locations, this is a very reasonable starting point. In some, you're going to want more. In others, you have to maybe be a little bit concerned because we're going to have a little bit more production. The big thing to using options for me is when you exit that position, right? Carrying it, if it's out of the money until expiration, is in general a very bad idea. What you want to end up doing is saying, okay, when's that risk interval and how can I end up exiting and recouping some of that premium? The last thing I just want to reiterate, this is something that I've been beating the drum pretty hard over this winter season, is I really like having access to storage. It provides a ton of flexibility in our marketing program. It does allow us to help reduce harvest delays at elevators and delivery points. If you do have aeration or drying capabilities, you can harvest at a bit higher moisture. It spreads out your labor requirements. You avoid some of these seasonal price lows, and you can extend that marketing window and reduce the production risk during the marketing cycle. So again, I know there's a lot of people that don't want to get too much priced during the marketing season because they don't know what, or during the growing season because they don't know what they're going to have at the end. Well, if we have storage, what we can do is we can look at extending that marketing window and end up doing sales to some of these terminal markets. One of the biggest keys to storage is to knowing what your terminal market. So where can a producer deliver that final product for the highest cash price, right? And so just identifying where our terminal markets are for corn and soybeans is very important for our producers. When we look at cost considerations, I did want to end up putting this in because it is something that is sneaky. I've spoken a fair amount about interest rates, but there are kind of two different components that we need to break down in terms of interest rates. The first one is kind of on the capital side of things. So if you are putting up bin infrastructure, for example, you're going to be at higher costs, and then you're going to have higher financing costs as well. So that's going to increase our cost. The other thing that I think is really important is if you're carrying grain in storage, there's a time value based on if you've got an operating facility or even if you're using your own money that you're paying interest on that while that grain sits in storage. Whereas if you had the cash sale, you'd be able to pay that down and alleviate some of that interest. And so just a quick example, when we look at 5 months worth of storage coming out at 4.2 cents per bushel, it's just another factor that we need to end up considering as we're carrying grain in an elevated interest rate environment. I did mention we updated these average storage costs or average storage gains in price. These are cash prices. It's a 10-year average for corn. So if we avoid or if we sell our crop in September, that's usually the harvest low in Tennessee. If we hold it until March, on average, we'll get 87 cents per bushel more than if we sell it at harvest. And again, I fully recognize every year is going to be a little bit different. We're going to get highs, lows in this return. But when we're looking at investing in grain bin infrastructure, a 10-year return like this, you can make a pretty strong argument that this is going to pay for the vast majority of producers. You look at the same thing for soybean cash price movements, avoiding that harvest low, even into March or January, if you want to end up looking at $1.03 to $1.35 on average. That's a pretty good return and can end up paying for a lot of storage. And so when we look at this, again, I'm a huge proponent of making sure that we have access to storage for our crop because it allows us to take advantage of some of these opportunities. So just before I turn it over to Andrew here, I guess my take-home message is there's still a lot of global economic uncertainty and political tensions. That adds a degree of volatility in our input and output price markets that I think really necessitates managing that risk, particularly for the commodity markets on the future side of things. I think getting some type of floor or protection on the future side and maybe leaving that basis open, particularly on the new crop, I think is a really prudent risk management move this time of year. Input costs are coming down. I really like the trend, but again, the volatility or uncertainty is something that I'm not a huge fan of. It's been a kind of reversed compared to the 2022 crop, when if you bought your inputs for 2022 in the fall of 2021, the earlier you bought them in general, you probably made out better than those that had bought them in the spring. But this year, if you did the reverse, so if you waited until the spring, you probably made out a little bit better in terms of your cost structure. But again, in general, I think we are seeing inputs come down a little bit, but we're still at elevated levels. So what we want to really avoid is that margin squeeze where we see new crop prices fall when we've already purchased our inputs and we end up having that margin deteriorate. The volatility, I don't think is going anywhere from agricultural markets. There's still too much uncertainty for the 2023 crop, and we're coming out of a reasonably short stock position. And what that's going to end up doing is we're going to have a break at some point this spring or summer, one direction or the other. And so again, I think we're gonna be in for some more volatility there. So we really need to think about how can we manage our price risk. And I do like this little formula here in terms of crop insurance plus price risk management plus storage. I think it's a winning strategy. How you want to end up piecing those components together, you can break those down in different ways. But I think this ends up working well for a lot of our producers. So with that,